Peloton just announced earnings and projections, and it wasn't good. But before you make any assessments, whether it's a good stock or a bad stock, I want you to remember that our job as investors is to evaluate every company based on the data we have today and our assumptions about the future. So first, I'll start by showing you guys what everybody's probably focused on, this chart. Now, if you go back to our past videos on Peloton, you will see that we said very consistent things. One, can Peloton continue this growth even though they surged because of COVID? And we talked about this, whether a company surged because of COVID or fell because of COVID. We always said, be careful here. You have to assume there'll be a pullback in revenue if they surge because of COVID. And if they fell because of COVID, like Carnival Cruise Line and all the airlines, that's not a permanent thing. The stock peaked right here about a little over a year ago at $180 a share. Go back to our past videos. Now, pre-market, it's down to $12 a share. 18 months later, guys, it is down over 90%. Over 90%. We said be careful here. We said we didn't like the stock at this price. But I don't want you to ever take your bias here and translate it to down here. Just like I wouldn't want your bias here to translate up here. If you think it's a great buy here, that doesn't necessarily mean it's a great buy here. That is called recency bias. We want to avoid recency bias. What we want to do is evaluate every single company based on the data we have today. So they just announced earnings. Let's go directly to their press release from the company to look at it. So what was projected? They were projected to lose 83 cents per share. They lost over $2 per share. They were projected to generate about $974 million in revenue, and they generated 964. So they barely missed there. But here are the interesting things, guys. This is their third quarter of 21, second quarter of 22, which was last quarter, and their third quarter of 22 just announced. Guys, look at these gains. They have a lot of gains. Now this one right here is the fitness subscription additions, the growth rate. So the growth rate slowed. It didn't go down, but the actual subscription did not go down, but the growth rate slowed. All of these numbers are up, but it's about understanding what makes up those numbers. Let's go to the very next portion, the financial results, dollars and millions. Now look at their revenue, guys. This is concerning. Connected fitness products revenue. This is their actual physical products. And remember, guys, it's funny. People say to me, oh my God, Paul, you called this. I didn't call it. I felt like a business person. Okay, if Peloton skyrocketed because people were forced to stay home, what happens when people are not forced to stay home anymore? What happens when the world opens back up again? Well, look, revenue fell almost in half, down 42% from the third quarter of 21. Okay, subscription revenue. Guys, look at this. Subscription revenue is up year over year and quarter over quarter. That's a positive sign. I look at this business as how much money they can bring on their subscriptions. Okay, this is a subscription-based business. Yes, they sell, fitness equipment, but guess what? The CEO just announced a massive drop in equipment pricing, and that led to a 69% increase day over day in equipment sales. Okay, total revenue down 24% year over year and down 15% quarter over quarter. These do not sound good. But again, don't put your bias going forward. Evaluate the numbers every single time and what your assumptions about the future will be. The gross profit is what concerns me, guys. They had $290 million in gross profit down to a loss of $68 million. That was their gross profit collapse due to dropping prices on their equipment to get more equipment out there. You can tell from that their main focus is going to be subscription-based revenue. When they're dropping it's kind of like video games, guys. Video game companies a lot of times will sell the consoles at a loss. Why? Because they want you buying the games. They're going to make their money on the games. They don't care about the actual console. They want the games. Same thing here. They should not be as worried about the equipment, making money in the equipment. What they want you to do is pay them $48 a month every single month to be part of their community. Okay? Their connected fitness products gross margin, look at this, guys. The gross margin went from 28.4% down to a loss of 11.4%. This means on every piece of equipment that they sold, they lost 11.4% directly. They sold it for 11.4% below their cost. Again, not necessarily a terrible thing. The thing I don't like about it is it went from 28.4% down to a loss of 11.4%. Subscription gross profit, though, look at subscription gross profit. Up from 154.5 to $252 million. That's a 63% increase. Subscription gross margin, the gross margin's up. They're making more money per subscription now on every subscription signed up. Now, total gross profit, major fall. Total gross margin, major fall. Operating expenses, doubled. Guys, so from this standpoint, there are some positives here. The positives are people are still buying their subscriptions and keeping their subscriptions. Now, the subscriptions, though, are going to grow as they sell more and more equipment. And the equipment sales have definitely fallen. Not only that, the CEO just announced that they are thinly capitalized. They only had $870 or so million left in cash and cash equivalents right now. They just went to JP Morgan and Goldman Sachs, the two investment banks that took them public, and secured $750 million in debt to help them get through their turnaround process. This turnaround is about subscription revenue. That is what it's about. So to me, when you're looking at the future of this company and evaluating it, you have to look at what's the community and what are the subscription numbers going to be. So let's go take a look at more information here on our site. So let's go to the 8 pillars initially. Now here's the deal, guys. Not enough data. This company hasn't been around long enough. That's the problem. So but look at this revenue. $216 million back in 2017, $4 billion last year. But this is going to fall. This is definitely going to fall. Let's see quarter numbers. The last quarter of last year, $1.13 billion. It was still growth from the previous year of 1.06. But again, subscriptions are the future for this company. That is the absolute key for this company. Now, one thing I do want to look at is, look at their shares outstanding, guys. This is scary. They have 317 million shares outstanding at the end of last year. Just 2 years prior, they had 280 million. That's a big jump. That's a 10% jump, over a 10% jump right there. That's a lot. They are issuing shares. Why? Because they're losing money like crazy. There are two ways to cover losses, debt or equity. They probably chose a combination of both, right? So you got to remember, when they're doing this, when they're issuing shares, they're diluting our owners. They're diluting you as an investor. But remember, every investment is the present value of all future cash flow. So we have to ask ourselves, what is the future cash flow of this business going to be like? And here is the hard part, guys. When we go to an annual basis and we look at the profit of this company, negative $1 billion last year. The previous year, they made $166 million, lost 200, lost 110. The hard part for me analyzing a company is, where's the profit here? I don't know what their bottom line profit will be. There is no guidance to me to tell me what's this going to do. But we can make assessments and we can make assumptions and look at it and see, okay, what's this company looking like? Well, first off, what we do know, it's a $3.7 billion company. Now, I will say this. Software businesses, which I think you'd consider this a software business at some point it will be a software business, sell for 6 to 10 times revenue. This one's selling for 0.9 times revenue. But a big chunk of that revenue is equipment sales. That is a big chunk of the revenue. It's not as high gross margin. We saw they're actually losing money on equipment sales while their gross margin on the subscriptions are going up and up and up. 70% gross margin. Those are software margins. Okay, so you have to say to yourself, if this becomes a software business, can they at least break even on their equipment sales and focus on the software, the community, and all that stuff? Listen, I have a Peloton. Mo has a Peloton. He loves the community. He loves going on the bike, doing that. To me, I'm trying to do other things in my Peloton. I'm trying to play chess or do stock research or some sort of investment research, so I don't use the community at all. That's for me. But a lot of people need that motivation. They love that motivation. They've got beautiful people motivating you on the bike, like, let's go, uphill, let's do this. So there's a lot of value to that. But remember, this is a hype company. If I had told you a year and a half ago, this stock would be down over 90% in 1.5 years, first off, I didn't even need to tell you that. When we said in our videos about how it's overpriced, you're dumb, Paul. You don't get it. Guys, every investment's based on fundamentals in the long run. And once the hype ran out, it dropped. So valuations matter, and they matter very quickly. So let's go take a look. I'm just going to run right to our stock analyzer tool. And as you guys know, who've watched the channel, we use the stock analyzer tool to sit there and figure out what we want to pay for a company, because I will repeat it till I'm blue in the face. Every investment's a present value of all future cash flow. So first line, revenue growth numbers. Guys, I'm going to be conservative. I'm going to call it 3, 6, and 9% revenue growth. Now, profit margin. Guys, we don't have a profit margin to look at. They haven't made money overall in the last 5 years. So we don't know what to put. But let's sit there and assume 8, 12, and 16% profit margin. Free cash flow margin, I'm going to do the exact same thing. PE, 14, 16, 18. Price to free cash flow, same thing. And a 12.5% return. Now, guys, here is what I want to keep in mind. We're going to hit the analyze button. And it's going to tell us, based on these assumptions, what we should pay for the company. Now, keep in mind, these assumptions assume profit this year, which we don't have. So you still have to discount it a little bit further from that. What you might want to do then is, instead of 12.5%, make this 17.5% gross profit, desired return, because you're factoring in some unknown things that it's going to go forward. So let's hit the analyze button. So guys, this ain't bad. This might be a buy here. And I'm sure a lot of people watch this channel going, what? Peloton a buy? But that's exactly it. You have to make your assessment based on the new information. Don't let the recency bias of the stock falling over 90% tell you the stock is not good. In fact, you want to do the opposite. You want to look for those opportunities when stocks fall a ton to say this might be a buy now. Don't let your bias about the company affect you on the high and the low. So in this company, if you believe all these metrics, it might actually be a buy now. As crazy it might sound. Now, one thing I want to make a comment about, I wonder if Peloton's going to be acquired by somebody. Imagine Apple going, we've been talking about this for a long time. Go look at our past videos of Peloton. This is a $3.6 billion company. Apple makes $3.6 billion in like 14 hours. Not literally, but this would be great for their entire community. Imagine integrating Apple products into the Peloton system. That's where I look at Peloton saying there might be some potential. And you're telling me right now, there aren't companies out there looking at Peloton going, man, it's fallen over 90%. Maybe we should take a look at it. There has to be some people doing it, especially Microsoft, Google, Apple, these big players at $3.7 billion is nothing to them. And they have the software ability. They may not even need the developers from Peloton because of all the developers they have on board. So when we're looking at companies, I'm going to repeat till I'm blue in the face. Don't let a 90% drop tell you to avoid the company. It should be your indication to start paying attention to the company. And with Peloton, if you believe these numbers, go do more research. It might be the right time to buy.